Hey everyone, here's something I thought you might find interesting. I get a lot of people that ask me, well, how do you value a stock? What do you think is a good deal? And not that I endorse any individual stocks in particular, I always tend to gravitate towards ones that people are more interested in, such as Apple, Google, and use those as reference. I think the first thing you need to do is just get a grasp on the idea that a stated share price really means nothing. It's a benchmark against what people are buying equities for and what they value that stock at any given point. That doesn't mean it's accurate. It doesn't mean it's inaccurate. It just means that's what the price is. But if you break down valuation to its fundamental components, what you're trying to say is, I plan on holding this equity or this investment for a period of time. And based on historic trends, what do I think it's worth as measured from a growth in earnings per share standpoint? And how do I discount that back to today's term based on my required rate of term? When people use the statement, well, the market's overvalued or it's undervalued, I know what they mean. What they're saying is, trending back to the historical mean, yeah, it's probably overpriced and your future returns are probably going to be less than average, or conversely the other way around. But everyone has a different target. Some people may be okay with a 4% or a 5%. Some may want the standard 7-8%. Some may require 12%. So it's also important to say it's under or overpriced based on what my anticipated return requirements are going to be. With that being said, I pulled all this data from Apple. A good place to pull information is from Yahoo Finance. You can download the historical information from any stock, also stock valuations adjusted for dividends. Macro Trends has a nice EPS chart where you can copy and paste it in here and look at your trailing 12-month average or a 5-year trend or however you want to look at it. So from a macro perspective, let's look at this high level. In gray here, you'll notice what the average price was per quarter. Now it'll fluctuate between the months, but these are quarterly average benchmarks. Notice how it has a pretty tight trend line with the last 12 months trailing earnings per share. It makes sense. Businesses tend to operate fairly similarly year to year. The farther you go out trying to extrapolate what the values are going to be, the more area that you're going to have. And notice here that in the last few quarters, the stock price has really rallied in comparison to what the EPS trends were. So that tells me two things. Either the value might be becoming a little bit overpriced in relationship to the earnings, or it's reflected to where investors are getting a little bit ahead of themselves based on anticipated earnings per share increasing. Apple EPS is very, very seasonal. If you noticed, around the last quarter of each year, it tends to spike. So that tells me that investors have seen trends over the last few years towards the tail end of the year to where they are comfortable with an anticipating earnings spike to smooth out that average. Maybe I can illustrate that for you. So if we grab all of our information, use the standard recommended chart, grab it here, change chart type, go to a combo box and secondary axis. Well, now you can see that it might make a little bit more sense. Notice that the last quarter of each year tends to spike fairly heavily. So I believe that even though it's a little bit overpriced now, if earnings tend to grow at the same rate, and then there's also seasonality, that the share price seems reasonable based on trends. Let's get rid of that. So there's two things I like to look at here. One is, what are the average PE ratio trends over time? And then also, what are the EPS growth? Small changes in these numbers can have dramatically different returns over a 5 or 10-year period. Over the last 5 years, the average has been 8.42% annualized increase. The last 12 months have been 9.04. And then analyst estimates give it 11.48. So what I did is I ran all three ratios, and I'll get down here in just a second showing what I mean by those. But if you look at, say, the average right now, 9.04, earnings per share trailing for the last 12 months is 12.79. The discount rate, or what is my minimum rate of return, I want it to at least match the market. Typically, you should have at least a few percent premium if you're going to dabble in individual stocks. And then the PE ratio is looking at historically, where has the PE ratio hovered? This is kind of hard for tech stocks because there's fairly high demand for, the FANG plus stocks to where they're trading at 20 plus multiples. I wouldn't say that going forward I would rely very heavily on that type of multiple, but do understand that each type of industry has a different multiple. For example, energy stocks right now are trading at below 10 PEs. Bank stocks are trading in a similar range, but it's not unheard of to see tech stocks that are sometimes 20 to 30, 35 PE multiple. Be very cautious as you increase those multiples. So what I did is I took what is the earnings per share now and ran it out 10 years at an average annualized growth rate up here. And from there we get a future value of what the stock would be, and then we discount it back at what our minimum rate of return is to get us a fair share value today. And what I did is I made a table based on a high, average, and low, or a low, average, and high, and a PE scalar or a multiple historically. So typically for Apple, the average PE has been somewhere around 15, 16, and it's even approaching 27, I believe, as of today. So I wanted to include that entire range, and everything always seems to gravitate towards an average. There will be times when a stock is expensive and it's inexpensive, but it tends to gravitate towards the median. So if you look at, what is a normal PE for a tech stock probably going to be in the next few years? I'd probably say in the high teens, low 20s. And if we discount that back, what a normal rate of return would be, notice that the 325 share price is somewhere in the middle here. Also notice that foots back to what my annualized return would be if I purchased this at $3.25 a share. I would get around that normal 6 to 7% before dividends. There's a lot more fundamentals that go into it, but most people just want a high-level calculation to kind of give a spot check of, does this make sense? Does this valuation make sense? Is it mathematically possible to get the returns that I want? And if so, where are they going to be? If you look at historically, what are the static pools for Apple's returns? And static pool means if I buy at a certain point in time, what is my yield for today? Well, notice there's very few times in history, if at all, at this current time, that you could have bought Apple and had less than 10% annualized return. Notice the volatility is fairly high if you hold it, say, less than 5 years, and then every increment that you go out longer, it tends to gravitate towards the mean. Well, that's the idea of investing, is you ride out some of the highs and you ride out a lot of the lows to where you're going to get your annualized average return that's very similar to what the EPS growth would have been for that company. You ask yourself, well, what happened in March when everything crashed and valuations went down 30 or 40%? Well, notice it still doesn't really change the yield that much, particularly some of these that if you would have held them for 40, 30 years, I would say it has a nominal impact on the yield just because of the compounding effect. But notice that how the annualized returns finally dip below 10%, down to, say, a 7% figure right here. It would have been punitive to sell at that point because it's actually below what the historic mean is. Don't sell when it's low, you should always buy more. So that wraps up my very quick, down and dirty evaluation of Apple. We got to look at EPS trends and how that correlates to stock price. We got to understand the very basic math that goes into growth and then discounting back to get a share value today. We reviewed what the multiples are on average and how the return and the price always tends to gravitate back towards a median number. I hope you find this information useful and informative. Please like and subscribe to the channel.